Hi, I'm Dave Penyuk of Revenue.com, and I'd love to share another quick real estate investing video tip with you. One of the best ways to get the biggest bang for your buck when investing in real estate is to invest in an emerging or undervalued area. So how do you determine what is an emerging or undervalued area? Well, before I jump right into that, I want to emphasize that in most cases, and generally speaking, you're best off to not be the first investor in an emerging or undervalued area. And why do I say that? Well, really, it comes down to you need a lot of patience and often some deep pockets to make sure that you can weather the improvement storm, shall we say, as the area does emerge. And if it doesn't emerge, then you could be setting yourself up for some losses. So if you're the first one, you may want to hold off and make sure that there's some other development and improvements going on before you start sinking your money and time into that area. So, without further ado, how do you identify an emerging or undervalued area? So what are the four main factors we use when trying to identify an emerging or undervalued area? Well, one of them is the Starbucks factor. Julie wrote a great article about this on our Revenue.com website. And basically from our experience across many cities and towns all over North America, we've seen it time and time again, Starbucks will often be the first or one of the first businesses to invest in a redeveloping or emerging area. We've seen this time and time again. So if you see a Starbucks in maybe a slightly rundown area, that might be an indicator that you should do some more digging into that area. Second factor is land being bought up. Are there a lot of vacant lots that were for sale for a long time? Are there boarded up buildings, etc., etc.? That type of again, building or lot that's been for sale for a long time and now you see sold signs. What's going on there? Talk to a local realtor that has a specialization in that area to find out who are the buyers of these sorts of things. You also want to look for rezoning applications. So do you see those big white boards on the side of a building or at a vacant lot that says rezoning application or development application? Again, you want to read through what is it saying. It'll often say who that builder or developer is. Find out a little bit more about that developer. Go online, call them, do that sort of thing. And also, what are the neighbors doing? What's going on in that area? Do you see a bunch of development going on and renovations going on with the businesses? So if you see some improvements already, that could be a great indicator it's an emerging area. Basically, we did all of these things before we bought a pre-construction condo in the King West area of Toronto 5 years ago. And to this day, we're now making about $400 a month cash flow on that property, and it's basically doubled in value. So we did our research ahead of time, and it's proved very, very wise and a good decision on our part, but you have to do that research. For making more revenue with real estate, make sure you check out revenue.com. Until next time.